Hi everyone, I'm Matt Crisafulli. I'm joined today by Ara Matt. We are ACap advisors and accountants, and this is the ACap ReCap, where we go beyond the blog to dig a little bit deeper into questions and concerns our clients and our prospective clients have brought up. Today we're going to be talking about 401ks. Traditional 401ks, Roth 401ks, what's the difference, who are they good for, all the questions we get all the time. So Ara, what type of 401k should I contribute to? Traditional 401k or a Roth 401k, and why?
Well, first off, you should be contributing to your 401k regardless.
Right.
But as far as what type of 401k to contribute, then it's also based on a number of factors. I don't want to say depends all the time, but it really does depend on your tax situation, your age, and a few other variables as well. But for the time being, let's talk about the main differences between the Roth 401k and the regular 401k, and why one may be better than the other in a certain circumstance. So what most people are familiar with is a regular 401k. It's been around since the late 70s, and the regular 401k, you can put a really large sum of money into it every year, $19,000 into it. The money you put in is tax deductible, so you get a big tax benefit when you put in, and the money grows tax deferred. So as you're working during your working years, the money grows tax deferred. Once you start taking that money out, then you'll start to pay tax on it. So it's got a tremendous amount of growth opportunities from that perspective. Also, if you have an employer match, that's also a great reason to contribute to your 401k because that's free money. You don't want to give up free money. So if you have a 401k match, definitely put into it. The Roth 401k is a relatively new account. It's kind of like a spin-off, if you will, of the Roth IRA. And the Roth 401k works very similar to the regular 401k. You can put $19,000 into the Roth 401k. That's a big benefit because the Roth IRA, you can only put $5,000 to $6,000 into it. So it's a huge difference versus the Roth IRA. But the Roth 401k grows tax-free. You don't get a tax deduction a year you put money into it, but that tax-free growth is really powerful. Whether or not to contribute to one account or another depends on your tax situation and what you think perceived tax rates are going to be like later on. We like to take the approach of having money in all types of buckets. So you have some money in tax-free bucket, some money in tax-deferred, and some money in a taxable account. So with that said, you try to kind of split off some money, put some money in a regular 401k, some money in a Roth 401k, so that way you're kind of filling up both buckets. I mentioned an employer match. If you do have an employer match, that cannot go into the Roth 401k. It has to go into the regular. Yeah, that would be great if it goes into the Roth.
Right.
Into the Roth, and that goes tax-free. The other benefit of the Roth 401k is that once, let's assume you leave your company and you've got that money there, it's totally portable. We always recommend clients roll that over into an IRA or a Roth IRA. The Roth 401k, you can roll over into a Roth IRA. So that way it's still portable for you when you leave that company.
Yeah. I think, so one point to clarify is that the annual limit is not into both the Roth 401k and traditional 401k. It's an aggregate limit between the two.
Yes, that's
so
right.
If it's a $19,000 limit and you can put $10,000 in one bucket and $9,000 in the other, but you can't max out both. So that's a question that comes up all the time. People want to get the most tax deduction, but also want to save the most for retirement. And unfortunately, at least not yet, you're not allowed to put that much away for retirement.
There's also another confusing part for a lot of employees is that they think with the employer match that counts towards their $19,000. That's not true. So you could put $19,000 of your own money, and whatever the employer matches, that's on top of the $19,000.
Right. Yeah. So I mean, to your earlier point, if you have an employer match, take advantage of it because
it's free money.
It's free money, and it doesn't take away the amount that you're able to put in. It's just extra savings for retirement. And rarely ever do we come across a case where someone has too much money saved for retirement. It's usually the opposite. So absolutely take advantage, maximize it if you can, and diversify between accounts. One of the other things I wanted to ask about the Roth 401k is, maybe you can elaborate on it a little bit further. Why does my employer contribution, or the match for my employer, or profit sharing, why can't that match my contribution? Why does it go into why does it go into the traditional 401k and not the Roth 401k?
So that is an IRS rule. It's not a rule that's imposed by your employer. They're not trying to be mean to you by doing that. It's an IRS rule that just says that contribution has to go into the tax deferred bucket. And as far as the rationale behind that, most likely because the employer is getting a deduction for that contribution. So the IRS does not want to get does not want that money to get a deduction and grow tax-free. So they're thinking if you're going to get a deduction for as an employer, then someone's going to have to pay tax on it.
Right.
So that's probably the thought process behind that.
Yeah, there's no free lunch, which I'm sure we've said a number of times in the office and a number of times in the ACap ReCap.
And it still remains true. There's no such thing as a free lunch.
Absolutely true. So this has been the ACap ReCap. Basically, your 401k, the Roth 401k, if it's offered by your employer, great option. Traditional 401k, also a great option. The important thing is to diversify across different types of accounts. Thank you for joining us. You know where to find us if you have any questions. Our website's acapam.com, and we look forward to seeing you next time.